state of flux is what you could argue markets are in currently, and one would argue when are they not. The question is though that with the quantum of ponderables and events around us, how does one navigate through this slightly uncertain period? Let's get in a very important market voice, Mr. Mahesh Nandurkar. He's MD and HR at Jefferies, joins us right now on the show. Mahesh, great having you. Hope all is well.
Thank you, Neeraj. It's always a pleasure.
Thank you so much. So Mahesh, put this into context. How are you approaching the landscape in light of the fact that we are on the cusp of a major change in action by the central bank that matters, maybe in even our own central bank, and with the other pieces into play, what do you think about the most?
Yeah. So Neeraj, just to give you a quick sort of backdrop of, as you rightly mentioned, the change in the stance by the US Fed, and what I find very interesting, and in fact that's what a lot of the institutional investors also continue to sort of wonder about, is that yes, that much expected turn in the policy for the Fed has happened. That's the case with several other central bankers as well. Our own RBI, although they haven't really raised the rates yet on a headline basis, but they have given enough indications and some other instruments that they have launched, which are effectively pointing towards a hike in the policy rate as such. And all these things have been well captured by the bond market. You can see globally, the bond yields have gone up. Even in India, the same has happened. But it's interesting to see that the same has not really been reacted to by the Indian equity markets, to some extent even global equity markets as well. Because I think what is happening globally and of course in India as well is that a large part of the net buying or bulk of the activity is being driven by the individual investors, the retail investors, either directly or indirectly through the mutual fund route. And that is clearly something that is I would say offsetting the negative impact, so to speak, of the yields going up globally and in India. So it'll be interesting to see, I would say the tug of war between the globally the yields going up and the retail investors, sort of trying to offset that.
Mm. Mahesh, I plan to ask this to you a bit later in the interview, but I'm asking this to you up front. You were so spot on the last time that we spoke when it came to what could trigger a return of the FIIs, if at all, or for how long they keep on selling, including the currency factors that you had spoken about then. Now, my question to you is, keeping into mind all of the factors that are there, including valuations, but also the point that retail investors are buying. Now, the hypothesis that I'm laying out is that if the retail investor continues to put in money and therefore valuations don't succumb too much despite earnings corrections, uh, when does your large set of clients think of returning back to EMs in general, in India in particular?
Well, see, I can tell you that this global change in the investment style to move away from growth stocks and growth markets to value markets or value stocks probably started towards the second half or towards the fourth quarter of the last calendar year. And we did see investors starting to cut down their weightings in expensive stocks and expensive markets like India, and moving towards more value markets like China, although that trade hasn't really worked out because India continues to outperform the regional benchmarks quite nicely. But what we've seen is that the foreign institutional investors still don't seem to be in a hurry to get back into India. We have seen incrementally the money moving into LATAM markets and also some of the other ASEAN markets, where which are considered to be like a better opening up place, or where the central bankers have taken a more sort of proactive stance of rate hikes, etc. I mean, in Brazil we have seen almost 800 basis point rate hikes. In Mexico we have seen a 400 basis point rate hikes already, and in the ASEAN markets, which clearly benefit from the global travel opening up, tourism, etc. So those seems to be the markets that the international investors are favoring. And we are seeing the impact of that here in India. For the last almost 6 months now, we are seeing continuously about $3 to $4 billion being sold every month. And while that seems like a lot, Neeraj, but if you look at in the context of the total foreign investment stock in India, that's still upwards of $600 billion, right? So what we have seen in terms of selling, say about $20 billion or so in the last 12 months, bulk of which is in the last 6 months, is only 3% of the total stock. And the valuation gap between the Indian markets and the international markets or the other Asian markets continues to widen. So I don't get a sense that the institutional investors will be rushing back into India. The global investors, I mean, will be rushing back to India in any hurry, so to speak. And I would probably go one step ahead and say that I will not be too surprised if this type of a selling of say $3 billion, $4 billion, something like that per month continues for another 6 to 12 months. I'll not be too surprised with that.
Wow. Okay, Mahesh. So in which case, what is your current stance on equities from a 12, 18-month perspective? Or if you're not looking that far out because of the number of events surrounding us and a slightly shorter time frame? Suit the time frame according to what works there for you best. Or what's your current stance therefore, and what are the factors driving that stance?
So my sense is that in this context where the institutional investors, the global investors, seem to be pulling, some money out of India, and the valuation gap between India and elsewhere in the world continues to widen. And in the context of what we are likely to see going forward in terms of the rates, the yields going up, not just globally, but probably in India as well. I think it's not a very conducive market for equity market, so to speak. I mean, clearly, we have got a huge support from the domestic retail investors for sure. I'm very bullish on the economic growth, and the corporate earnings growth. So I feel that even this year, FY23, the corporate earnings growth will be about 15%. So even if the market kind of moves sideways, say over the next say next 12 months, or let's say next 9 to 12 months, the valuations will automatically correct by 15% because the corporate earnings growth is up to that level. So my sense is that maybe we probably see a combination of small market corrections which will get bought into by some of the investors, and maybe for a reasonably prolonged period of time, say 6 to 9 months, we just see markets moving sideways. I don't really see any big upswing or any sort of big positive returns coming in from here, at least in the remaining part of the CY22.
Uh, it'll be a lovely conversation around Diwali with you, Mahesh. I can promise you that. But but, but let's try and then therefore dissect this. I heard you mention that you are kind of constructive on the earnings growth picture. And the larger commentary seems to be that there will be some issues in quarter 4 because of the input cost pressures for most companies. Even if a large portion of the Nifty may not get impacted out there, but maybe Nifty 500 might see that. And IT may not have the material cost pressures, but the wage hike pressures are therefore definitely there. And it might get exaggerated in quarter 1 as well because some of it might not be captured. You saying despite this kind of margin pressure, you still expect about a 15% growth in earnings for FY23. Is that a correct assessment?
Yes, that's right, Neeraj. And the reason for that is we are seeing margin pressures coming in from certain sectors. Primarily, those sectors are autos and cement and consumer staples, other consumer durables, and maybe some segments of industrial, even pharma as well. But all these, 6, 7 sectors put together is about one third, of the market by weight. Uh, I would say that the most of the other segments like banks and financial, which is roughly 35 to 40%. Yes, IT we have seen some pressure, but by and large, I don't think we are likely to see more earnings revisions on the downside from here on because the demand growth stays very very strong, and in my likelihood, the sector will also see some benefit coming in from the currency depreciation, the expected currency depreciation as well. So that is about another say close to 15 to 18%. And then we've got some other sectors like telecom, and metals, etc., where we are unlikely to see earnings cuts. To some extent, even energy sector as well. So by and large, two-thirds of the market will not really see earning cuts. One-third of the market is seeing earning cuts as we speak. So therefore, the overall impact is not going to be, a whole lot. I personally do not feel that there's going to be a big revenue disappointment, because what the market has factored in as of now is margin level disappointments, and those are, I think, pretty much factored in now, and that's why you've seen some earnings cuts. On the revenue side, I don't really see too much of a disappointment. So therefore, on an overall basis, I do expect the broader corporate earnings would to be around 15% for FY23.
And valuations will keep on getting justified, because I remember a conversation wherein you had told me that people will find ways to justify by saying this index X something or this index X something looks reasonable. You think that will continue?
Yeah, which is what is happening as of now. The overall index is kind of pretty much, I would say, stable now for the last, say, 6 months or so. I mean, it kind of goes up a little bit, comes down a little bit, but like by and large moving sideways. And I think this is the kind of trend that I expect for the next 6 to 9 months as well.
Got it. Mahesh, so if the markets were to stay stable, do you reckon that for most sectors, the pressures on the downside or the positives on the upside will not be very stark, or do you reckon that there will be stark uh, pressures both on upside and downside, and they will kind of negate each other? And if so, where is it that you believe the earnings growth and therefore maybe the buying interest might be maximum? And where is it that you believe the selling pressure would be maximum?
So I am actually quite bullish on the banking and financial sector, because I believe that that's a sector which is not only driving good earnings growth. We are expecting a 20% plus earnings growth for the sector in FY23. And I mean, we've got a good combination of a reasonably strong earnings growth. The sector fundamentals are also looking pretty good in terms of the NPL ratios going down, and whatever NPLs are there, kind of well covered, almost 70% sort of provisioning cover for most of the banks, and the incremental sort of cost, the provisioning costs are going down therefore. So on an overall basis, I feel pretty optimistic about the sector. Also, we're now seeing the credit growth inching up, a little bit as well, although not a whole lot. I mean, we are close to about 9% level, not that an exciting number, but if you look at the incremental credit disbursement over the last 6 months, that actually paints, a reasonably good picture. So I would say that is one sector where we have seen a reasonable amount of correction. The valuations are looking reasonable. So while one can argue that valuation is a concern for many parts of the market, but definitely not for banks and financials. So that's clearly one sector that I quite like. Obviously, the issue with that sector is the continuous foreign selling, because foreigners own a large chunk of that sector in India. But I would still say that the risk reward still seems favorable if one has a slightly longer term view. I would also say that in due course of time, I'm pretty optimistic about the economic recovery in India, the broader corporate spending as well, which we think will be sort of fueled by the property sector. The housing sector continues to show sort of very good promise, and most of the corporate spending cycles or corporate capex cycle sort of also are initially based on or emanate, I would say, from the housing sector upturn. So that segment of the market is where I still feel quite optimistic if I take a 12-month or a longer view.
Sorry, just what balances that optimism? What might see some serious selling pressure, if you will?
See, the sense is that if you look at the earnings trajectory, as I mentioned, there are a few sectors. I mean, particularly some sectors like cement, where we're seeing a combination of cost pressures, but not adequately sort of balanced by the product prices going up to the same extent. And we are seeing some earnings revisions on the downside. So that is one segment. I would say, broadly speaking, the rural facing sectors like like the consumer staples, I would say even the entry level two wheeler, which are also more exposed to the rural markets. Although one can say that there is an incremental trade here, trade on the positive side on these rural facing sectors, with the global food inflation going up and the expectations that the same will help Indian farmers as well, and therefore the rural situation will improve. I think that tailwind is rather small according to me, and the history suggests that the Indian food prices are not really correlated with the global food prices. But yes, there is a sentimental positive which is coming through because of this, incremental optimism around the rural recovery. But I feel that if you take a slightly longer term view, staples and the other two-wheeler segment, especially at the entry level, will probably continue to see pressure. I also feel that some of the segments on the the material side, the metal side, I think are showing signs of peaking out. Our own house view is that uh, the the metal cycle will probably will not have many legs, because especially if you're talking about multiple rate hikes in the US, and the expected sort of global slowdown that will ensue as a part of that.
Got it. Yeah, I did see that you changed your stance, though you didn't go overweight, but you changed your stance from underweight, I believe, to neutral on the staples side about, I think, a couple of weeks ago, if I'm not wrong.
Yeah, that's a more a tactical stance where we added the weight on the consumer staples. And as is mentioned, I think I do see a trade there. Yeah.
Got it. Okay, last couple of questions, Mesh, won't make it too long. One, you were amongst the earliest ones to identify and speak continuously as a house on property. I'm just trying to understand that within these new things that are getting formed, the whole PLI gamut that is out there, defense, which is becoming that whole Atmanirbhar concept, is there something that you believe could have a multi-year run?
No, that definitely looks like a great story, because we also hear from our own counterparts in the other parts of the world that the corporates are looking at diversifying the manufacturing base outside of China, and India is looking like a great alternative. And we have seen some early success. We have seen some early success in um, in some segments of the electronics value chain, chemicals sector, some kind of agrochemicals, and pharma space, like CDMO and CRO space. So I think some of those segments are also looking pretty interesting from the longer term perspective as well. But a lot depends on how we are able to consolidate our positioning here. I mean, on the electronics chain, for example, we are just doing a 10% value addition, right, which is just the the final assembly of the units. But ultimately we have to kind of step up and increase the sort of percentage of value addition that we are doing here in India. So a lot depends on that. And I guess in fact, just a couple of days back, I've been reading in newspapers as well that there seems like some some kind of a setting up of a fab in India as well. So let's see if those things go as per plan. But yeah, that space looks quite interesting for sure. So on a structural basis, say something like real estate is definitely one, but outside of that, some of these things would also be interesting.
Last question, Mahesh, 1 minute if you can. A word on the macro. We didn't quite discuss it, but do you believe any challenges from the macro, interest rates, the geopolitics, what have you?
No, I think macro is definitely challenging, because we are seeing the interest rates going up all over the world in India. The second issue is also that of oil prices. Uh, you know, mind you that even before the Russia-Ukraine crisis started, the oil was moving up already and was almost in $90 to the barrel even before that. So clearly, the risk that we run as a big oil importing country is what happens to the oil prices. I think those are the really two big sort of risk factors to watch out for.
Thank you so much, Mahesh Nandurkar. Really appreciate your time, and have a good time ahead in this earnings season.
Thank you. Thanks a lot, Neeraj. Have a good day.
Thank you. Viewers, thanks for tuning in.